Let's dive right into this. Welcome to this explainer covering the mid-2026 China Gateway 360 report. Today, we're going to use some sharp, data-driven analysis to break down a critical and honestly unprecedented divergence happening right now in the Chinese market. We're getting straight to the point to uncover exactly where foreign businesses are winning and losing today. The core thesis here, this isn't a slowdown, it's a split. If your mental model of China is just a unified, consumer-driven growth engine that is simply running out of steam, you need to throw that out immediately. The old playbook is completely obsolete because the data is telling us two entirely opposite stories at the exact same time. So, the fundamental question for foreign businesses, investors, and global strategists is no longer whether the Chinese market is growing overall. That is the wrong question. Instead, you have to ask yourself, which side of the divide do your operations fall on? Basically, which China are you actually operating in? Just look at the June 2026 Coxine data. It reveals a pretty jarring paradox. On one hand, consumer retail sales just shrank year on year for the first time since the pandemic lockdowns of 2022. But on the flip side, industrial output and factory floors are running at near maximum capacity. Factory gate inflation actually hit a nearly 4-year high in early June. And that's not because of broad consumer demand. It's driven entirely by rising input costs in advanced manufacturing, AI, and EVs. It is literally a tale of two entirely different economies.
Dimension 1, the consumer contraction.
Let's start by looking at the losing side of this split, the structurally weakening consumer economy, and why it's hitting foreign businesses so incredibly hard. The magic number here is 33%. Driven by a housing market slump that has dragged on for over 3 years now, plus elevated youth unemployment, household balance sheets are battered. Families are hoarding cash, and that's driven the savings rate up to a staggering 33% of disposable income. People are saving. They are absolutely not spending. And hey, when they do spend, their behavior has fundamentally shifted. Premium foreign brands are rapidly losing market share to guachao, which translates to the national tide of domestic brands. Chinese consumers are trading down. They are finding domestic alternatives that give them 70 to 80% of the quality, but at 50 to 60% of the price. If your entire strategy relies on a booming middle class blindly buying premium foreign goods, that market essentially doesn't exist anymore. Dimension 2, the AI and export boom. Now let's brutally juxtapose that consumer crunch with the winning side of the economy, where massive capital, major policy support, and genuine innovation are actively flowing. Over 150. According to the mid-2026 data, Chinese automakers are preparing to launch over 150 new EV models before the end of this year alone. It is a staggering scale of production that is driving a record wave of exports, expected to top 6.5 million vehicles this year. They aren't just building for the domestic market anymore. They are building for the world. And it is definitely not just cars. Cloud computing and AI data center investments shot up by an estimated 35% year on year in just the first half of 2026. What's really fascinating here is that even with international export controls on certain hardware, the software innovation is incredibly real. Chinese AI startups are making major breakthroughs in inference efficiency. They're basically doing way more with constrained chips, and that is driving immense capital straight into digital infrastructure. So what does this actually mean for you? Well, 40% of those 6.5 million projected vehicle exports are EVs. This massive acceleration in advanced manufacturing creates some highly specific windows for foreign businesses. You could supply AI infrastructure, specialized testing equipment, or advanced materials. You could form joint ventures, or you just have to be totally prepared to compete head-to-head with their export capabilities in third-party markets. Dimensions 3 and 4, changing maps and targeted policies. This economic split isn't just a concept, it is literally redrawing the geographic map of China and completely altering Beijing's foreign investment policies. Coastal powerhouses like Shanghai and Shenzhen are catching the full force of this AI and EV boom. They have the financial and tech ecosystems to back it up. But look inland. Corridors like Chengdu and Chongqing are competing so aggressively to attract manufacturing relocations. They are offering operating costs that are 30 to 40% lower than the coast, complete with direct rail links straight to Europe and Southeast Asia. And the government is steering this shift very deliberately. Their new 15-point policy plan makes it abundantly clear who the winners are: advanced manufacturing, R&D centers, tech-intensive services, and areas with cross-border data whitelists. Take the Tianjin Free Trade Zone, for example. They are rolling out a negative list approach, which means cross-border data flows are presumed permitted unless specifically restricted. The message is unmistakable. The red carpet is out, but exclusively for high-tech sectors. Retail and real estate get absolutely zero new concessions.
Case study tale of two companies.
Let's ground all this macro data by comparing two real-world foreign companies operating right now, just to see how this actually plays out on the front lines. Company A is a German precision engineering firm that supplies EV battery lasers. Their revenue is up 42%. They operate a wholly foreign-owned enterprise in Suzhou, and they are expanding capacity to ship to both Chinese customers and Southeast Asia. Then we have Company B, a European mid-market apparel brand with 120 stores. Their same-store sales are down 8%. Their core urban demographic is just trading down to domestic options. This massive performance gap is not about management quality, it comes down purely to sector alignment. Company A is positioned right where the economy is accelerating, while Company B is trapped where it's contracting.
The 2026 Strategic Playbook.
So how exactly do you navigate this landscape? The China Gateway 360 report outlines a rapid-fire, actionable 5-step playbook for foreign boardrooms. 1. Audit your exposure by sector. You really need to stress test your cost structure if you are in consumer goods. 2. Revisit your location strategy. Take advantage of those inland cost discounts if you're manufacturing. 3. Read the policy signals carefully to align with that 15-point plan. 4. Build for the export channel. Treat China as a base for third-market exports, not just domestic consumption. And 5. Watch those data releases closely to keep confirming these macro trends. I want to leave you with one crucial data point. 36%. Hong Kong foreign direct investment inflows are actually up 36% in the first half of 2026. This proves a vital point. Foreign capital isn't fleeing China. It is simply reallocating. It is actively moving away from broad consumption in real estate and aggressively pouring into tech, advanced manufacturing, and professional services. Which brings us to our final, defining question. Are you in the right China? In a two-speed economy, sector choice is strategy. Everything else is just execution. So take a hard look at your operations and the data we just covered and ask yourself, is your business positioned where the money is actively flowing, or are you fighting a structural decline? Thank you for joining me on this explainer, and I will catch you in the next one.